UBS is Switzerland's largest bank, and now it's all set to buy this crisis-hit Credit Suisse group. It's going to be a historic deal. It's a government-brokered deal. The Swiss government, to be precise, they're brokering this deal. And now they're seeking to address this unprecedented rout that we've seen in the stock of Credit Suisse and its bonds as well, all of which happened over the past week. The crisis at Switzerland's second-largest bank encapsulates the kind of turmoil that we're seeing in the global banking industry, which has been hit by the series of bank collapses. So really, it begs the question, what's really ailing the banks? Let's answer that from the very basics. You see, any financial system runs on trust. And when that trust is shaken, it leads to a classic bank run. What is a bank run? A bank run usually means a situation where all the depositors want to withdraw their money all at the same time. But banks don't sit with all the money of depositors. Instead, they lend that money. They invest the remaining amount to earn some profits. Now, it all started with the US's Silicon Valley Bank, SVB, which collapsed after a classic bank run in which SVB's depositors demanded close to $42 billion in one go. Now, SVB had seen this phenomenal surge in deposits all the way from $60 billion in the year 2020. It went up to more than $200 billion, all thanks to the tech and startup boom in the wake of the COVID-19 pandemic. But SVB put almost all its deposits in long-term US government bonds. And when SVB sold these long-term bonds prematurely to meet the sudden demand from depositors, it booked heavy losses. Something similar unfolded at Signature Bank after depositors demanded 20% of all its deposits. And soon, big US banks had to rush in to save First Republic Bank as well. The bank runs reflect a crisis of confidence, one that is only increasing with each bank's collapse. And now policymakers across the world, they are worried about the spread of this contagion. Central banks across the world, they are caught in a dilemma. While their primary mandate is to bring down inflation and restore price stability in the economy, they are finding that their sharp monetary tightening is actually increasing, catching banks and financial players off guard. So before the collapse of the Silicon Valley Bank, most analysts were expecting another 50 basis point hike from the Fed. But the turmoil in the global banking industry now has the Fed doing a bit of a rethink. Many are expecting the Fed to either pause rate hikes or to slow down the hike to 25 basis points this time. All eyes, of course, are now on the US Fed and its action that takes place this week. It will signal whether the Fed will prioritize financial stability or choose to continue the size and the pace that they've set on interest rate hikes.